You told your mate you're getting 5.5% on your savings account, and they nodded like you'd cracked the code. But here's what nobody told you about that number. You're probably not actually getting it. ING, Ubank, and Macquarie have built savings products that look extraordinary on a comparison website and feel ordinary in your actual bank balance at the end of the month. The advertised rate and the rate you earn are two completely different things, and the gap between them is not an accident. These banks designed it that way. Every single condition attached to your bonus rate is a mechanism built to reduce the number of customers who qualify, not to reward you, to catch you out. And if you've got rent, a mortgage, kids, or irregular income, the conditions aren't just inconvenient, they're specifically calibrated to trip up people in exactly your situation. So before you spend another month earning a fraction of what you thought, you need to understand what game is actually being played here. Most Australians assume their savings account is working as hard as it can. It almost certainly is not. According to the RBA, the average interest rate actually paid on at-call savings deposits in Australia sat well below the headline bonus rates advertised by neobanks throughout 2024 and into 2025. Roughly 40% of savings account holders fail to meet their bonus conditions in any given month. That means nearly half the people reading the headline rate never see it. Not once. And the banks know this before they print the number. Part 1. The bonus rate trap costing Australians hundreds of dollars a year. These banks are not offering you a high interest rate. They are offering you a conditional rate that most customers will never consistently earn. ING Savings Maximiser currently advertises a bonus rate that requires you to deposit at least $1,000 per month, grow your balance, and make at least 5 settled purchases on your linked Orange Everyday account each statement period. Miss any one condition and your rate drops to the base rate, which for ING sits at 0.55%. That is not a rounding error. That is a chasm. On a savings balance of $30,000, the difference between the bonus rate of approximately 5.5% and the base rate of 0.55% is roughly $1,485 in interest over a year. Gone. Because you forgot to tap your card 5 times or because your pay came in 2 days late. Take 2 Australians, both with $30,000 saved. One consistently hits every condition. One misses 2 months because she had an irregular freelance income month and a pay cycle shift. After 12 months, the first has earned approximately $1,650 in interest. The second has earned closer to $850. Same bank, same account. One decision, or in this case, one missed condition. That gap is not bad luck. It is the product working exactly as designed. So if the conditions are this specific, who exactly are these accounts built for? Part 2. The customer, ING, actually built this account for these bonus conditions were not designed for the average Australian worker. They were designed for someone with a perfectly predictable income, zero cash flow variability, and the mental bandwidth to track micro conditions across multiple accounts every single month. According to the ABS, approximately 2.4 million Australians were engaged in some form of gig or casual work as of 2025. If your income shifts week to week, the requirement to grow your balance every single month becomes almost impossible to reliably meet. Ubank's Save account requires you to deposit at least $500 per month to unlock its bonus rate of approximately 5.5%. Sounds easy until you have a month where rent took more, the car needed work, or your hours dropped. Macquarie's savings account bonus structure similarly requires monthly deposits to maintain the promotional rate. Compared to Australians earning $75,000 a year, one is a salaried office worker with predictable fortnightly pay. One is a tradesman with variable weekly income. Both open the same Ubank account. Over 12 months, the salaried worker qualifies for the bonus rate 10 out of 12 months. The tradesman qualifies for 6. On a $25,000 balance, that difference in qualifying months means a gap of roughly $580 in earned interest for the year. Same income, same effort. Completely different outcome because of the structure of their pay, not the quality of their financial decisions. And if the conditions are the trap, what is the actual alternative? Part 3. What a high-interest account looks like. Without the conditions, some savings accounts in Australia pay competitive rates with no monthly hoops to jump through. Macquarie's base savings rate for new customers sat at approximately 5.35% for balances under $250,000 through early 2025 as an introductory offer, while some smaller institutions, including certain credit unions, offered ongoing rates above 5% with no transaction or deposit conditions attached. This is information, not personal advice, but the mechanism works like this. An unconditional rate that you simply hold earns you interest every single day without requiring you to manage a checklist. On a $40,000 emergency fund, the difference between consistently earning 5.35% and averaging 3.2% because you miss conditions 2 or 3 months a year is approximately $860 over 12 months. That is a week of groceries for a family of 4. 2 Australians both hold $40,000 in cash savings. One keeps it in a conditional bonus account and misses the qualifying criteria 4 months out of 12. One moves it to an unconditional competitive account and earns the full rate every month. After 5 years, accounting for compounding, the second Australian has earned approximately $4,300 more in interest. No extra work, no extra risk. One decision made once. The problem is that most people never even look for the unconditional accounts because the neobanks with the conditions dominate the comparison sites. And why do they dominate those sites? Part 4. The 12 months that changed everything for late starters. The introductory rate period is the other side of this game, and it hits hardest if you are over 40 and trying to catch up. Many of these accounts offer their most attractive rates only for the first 3 or 4 months before reverting to a lower ongoing rate. For someone with $60,000 in savings trying to build a retirement buffer after 45, this matters enormously. According to ASFA, a comfortable retirement for a single Australian requires approximately $595,000 at retirement. Every dollar of interest you fail to earn in your 50s is compounding time you cannot recover. 2 Australians, both 47, both with $60,000 saved. One reviews their savings account every 6 months and moves providers when the introductory period ends. One sets and forgets. Over 10 years, the active reviewer earns an average of 4.8% annually. The passive saver averages 3.4% after rate reversions. The 10-year wealth gap on that starting balance alone is approximately $22,000. That is not a trivial number when you are trying to close a retirement gap. So if the banks are running this game, what is the single most important thing you can actually do about it right now? Part 5. The one move that resets the whole game in under an hour. Understanding the conditions on your current account is the most immediately valuable financial action most Australians are not taking. Pull up your savings account right now. Find the product disclosure statement or the account conditions page. Write down every single criterion required to earn the bonus rate. Check your last 3 months of statements and honestly assess how many months you actually qualified. This is how the mechanism works. The banks are counting on inertia. They know most people will not do this audit. The ones who do are the ones who either optimize the account correctly or move their money somewhere the conditions suit their life better. Rate comparison sites like CanStar and Mozo list current savings rates updated regularly. As of mid-2025, unconditional rates above 5% exist in the Australian market from smaller authorised deposit-taking institutions fully covered by the Australian Government Guarantee Scheme, up to $250,000 per account holder per institution. Two Australians both decide to act after watching something like this. One spends 45 minutes comparing rates and switches to an account that matches their actual cash flow pattern. One means to do it and never gets around to it. 12 months later, on a $35,000 balance, the one who acted has earned approximately $680 more in interest. 45 minutes of work. That is a rate of return on your time that almost nothing else in personal finance can match. The banks built the complexity to benefit themselves. Understanding it is how you take that benefit back. Most people will finish reading this and think that sounds like a lot of effort. But you now know something that most Australians sitting with their savings in the wrong account do not. The gap between the rate advertised and the rate earned is not a mistake in the brochure. It is the product. And the fix is not complicated. It is just awareness, one honest audit of your own account and one decision made with clear eyes. How much interest have you already left on the table without knowing it? That number is real, and it is waiting for you to claim it back.